financial literacy, we're often interested in value. How much is something worth? We talked about this in the context of shopping, and that there are search costs when we need to find out information to get the best price. Then there's transport costs if we need to travel to a sale that's often somewhere across town. So there was no free lunches. Now this is the same when we think about financial assets as well. An example that's present in the press at the moment, or media, is the question of the government wishing to sell down a partial stake, 49%, in Genesis Electricity. And so the discussion tends to focus on the politics of it, whether we should sell state assets or we shouldn't privatise state assets. And the point about value is missed. Right? If you put the shares in Genesis up there on the market and you have a fairly open bidding system, people bid for what they think they're worth, what they can get in terms of future dividends from the shares and any capital appreciation that they estimate or forecast might occur. So if you think electricity prices are going to go up, then you might think profit will go up and you'll get higher dividends. Lots of things need to go into this mix of how you would forecast what you think the future earnings might be and therefore what the shares might be worth. But if you say, oh, things are bad at the moment, then the shares might be worth less. And so the current discussion where people are saying, well, the shares would have to be sold at a heavy discount, doesn't make any sense. A discount on what? A discount on a different world where electricity prices were on the increase rather than the decrease? All the information is there in the marketplace and the shares will be sold at the value that people estimate they're worth. So if you're saying, well, we won't get the price that we ought to get, you're saying, I know a better price. Well, that's a bit like putting your car on Trade Me and saying, I want 4,000 for this, and you only get bids of 2,500. You can decline to sell it, but there was a cost of doing that. You didn't get the $2,500, and you've got to hold a car which you think is worth something, but the market thinks is worth less. Right, so if you're saying don't sell the shares because they're at a discount now, then you're saying, well, the market's going to go up in the future. Sell the shares, invest in something else, and the price will go up. Or sell the shares and invest in education, and perhaps that grows the economy. There's all sorts of arguments that the politicians might run, but the key thing is you can't say the market price is the wrong price. There are no free lunches. You can't decide that something's worth a lot more. Or alternatively, you can't really say, well, it's performing so badly, we should hold it and endure the costs and losses of holding it. We need to see through the promotional puff and look at the key things. Value is driven by what people are prepared to pay for it. And people, when they buy shares, are buying a future dividend stream and a future capital appreciation. They base their decisions on what they think the likely forecasts of the future are. And it is a brave person who says they know better than the whole market.